Hey, what's up, stock compounders? Brad here. So today I want to talk about a blog post that Chris Meyer just released. Chris Meyer, author of 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. So he gets a lot of questions about 100 baggers. And in this blog post, he picks out 4 of the most common questions that he gets and, gives his best answer to each one. And I think there's some really thoughtful ways to look at answers to these questions in here. So let's dive in. Where do you get ideas? I mean, that's something people seem most eager to learn about, right? When YouTubers make videos about specific ideas, the top 5 stocks they're buying, all that stuff, that goes crazy. Okay, people really want to know about new ideas. So Chris Meyer says, sometimes he uses screens. He has a friend who runs a fund and creates screens, and that friend shares some names with him. He gets ideas from talking to people, other investors, business people, analysts. He recommends FinTwit, the financial community on Twitter. Okay, I made a video not long ago about Twitter. We're going to get a bunch of additional names here of people to follow on Twitter, which is fantastic. Just today I went through probably half of these I hadn't been following. So it's great. I get to add some new idea generators on Twitter. So I'd recommend that to any of you who are on Twitter. Go through and add these people. What about portfolio structure, right? You're trying to find 100 baggers in your portfolio. How do you structure the portfolio? So 2 schools of thought here. The first is to concentrate. And according to this, Chris Meyer thinks about a dozen names is pretty concentrated. So a dozen businesses, maybe 8 to 10% each, at cost. And then hold for the long haul. Okay, that's one approach. The second is what he'll call the venture capital approach. This is what ARK does. Not just ARK, obviously. There's a number of funds that do this. More of the diversified approach. Create a portfolio of 30 to 50 companies, 2 to 3% positions in each of those, and hope a few of them hit. And that can be a very fair way to go as well. Chris Meyer likes the former approach, the more concentrated approach. He says there aren't that many ideas that meet 100 bagger style hurdles that Chris follows. That he can also get some conviction on owning, right? He's looking for that conviction where he really understands the business. It could be bought at a compelling price. He says he enjoys learning about and following the companies that he owns, right, at some depth. And he can't do that with the second kind of approach, the venture capital approach. It's just too many companies to keep track of. He says portfolio structure, it's more of a personal choice. There's no right answer. Do what you're comfortable with. What about valuation? So I found this section particularly interesting. He gets a lot of questions about valuation. If he had to rewrite the book, 100 Baggers, he might emphasize what he's about to say even more than he did in that original book. So let's dive into this. No doubt it's wonderful to find a situation where you have a low multiple and lots of growth. So you can get a lift from the twin engines, okay? Growth being an engine and that kind of price to earnings multiple being another engine. Those opportunities are often quite rare to find those twin engines. So Chris puts the business first, okay? Valuation second. And this is something I'm gravitating towards, kind of away from valuation, not away from valuation, but putting less emphasis on valuation, being willing to pay up a little bit for a great business. If you have a business that checks every box except valuation, Chris would not let that discourage you from owning it unless the valuation was something Pabrai would call egregious. You can always start small and build up the position over time. Another seldom mentioned side effect of focusing too much on valuation, it's going to make it that much harder for you to hold on. Okay? Because what happens when the market, in your eyes, fairly prices a company or even overprices a company? Well, it's compelling to trim or to get out and move on to a company that seems like it's really undervalued, right? That opportunity cost. And you lose sight of it can be easier to lose sight of the quality of a business and just sell because you feel like that valuation has been reached by Mr. Market. If you want to nab a 100 bagger or even a 10 bagger, you're going to have to learn to hold on to overvalued stocks. Okay? It happens in the life of a 100 bagger that the stock will trade well above what you think it's worth. Suck it up and hold on. But if valuation is a big part of your thesis, it's going to make it even tougher to hold on when it seems like it's overpriced. I mean, we've seen recently the example of Walmart. Pabrai has brought up the example of Walmart and how there were times back in the 70s and 80s when Walmart was trading at like 100 price to earnings ratio. But if you look back from where we are today, 100 PE 40 years ago, 50 years ago for Walmart, you'd have done incredibly well buying at 100 PE if you'd held on to today. So, less emphasis on valuation is what Chris Meyer is making a statement here for. So on valuation, you should try to ditch the following two ideas: the price to earnings ratio or price to book ratio, or enterprise value to EBITDA ratio, and many similar ratios are useful valuation metrics on their own. They are not. Sorry guys, I'm just going to refresh this here. Thank you, Apple, for this MacBook Air where QuickTime freezes on me. So ditch that you can use one metric that's going to give you useful information on its own. Let's focus on price to earnings ratio, okay? And this applies to all of the others. Price to earnings ratio is often used as a valuation measure, okay? Lower price to earnings is cheaper than a higher price to earnings, okay? That's very commonly held for value investors. But price to earnings ratio misses so many things. It's useless on its own, okay? Here's what price to earnings doesn't tell you. How much capital is required to produce $1 in earnings? A company that needs to invest $100 to create $1 annual earnings stream is not as valuable as a business that needs to invest only $1 to create $1 of ongoing annual earnings. This is that return on invested capital concept. How much of those earnings convert to free cash flow? Okay, free cash flow is really, what we can put in our pockets as investors, as owners of a business. A company earns $1 in earnings and converts that into $1 of free cash flow is more valuable than a company that needs to reinvest half of its earnings just to stay in place. Okay, very important concept. What's the return on capital invested in the business? Higher is better, taking into account to the future. What does the reinvestment opportunity look like? Does the business have the ability to reinvest its profits, and what do the incremental returns on that capital look like? Part of this is what phase is the company in? Is it in a growth phase? Is it maturity? Is it declining? A lot of these companies that are mature or declining, you see these big dividend payouts, right? Not necessarily as compelling for a long-term investor, someone like me who has decades ahead to invest, as a business that can reinvest the majority of those earnings back into the business at high rates of return. What does competition look like, or how sustainable are those earnings and cash flows, right? Where is the business in terms of, what what kind of moat it has. Can it fend off competition, or are there weak barriers to entry where there's going to be a lot of competition as time goes on? That's a start. Okay, there's no way to make a valuation judgment on any company without taking those things into account. Higher returns on capital with ample reinvestment opportunities that can go for years and years deserve higher valuations, way higher valuations. So we need to look deeper than price to earnings ratio. He says people forget this, and so you'll see somebody says XYZ oil royalty stock is better than TPL. I believe that's Texas Pacific Land Trust, because it's cheaper on a price to whatever metric. Of course, the returns on capital for Texas Pacific Land Trust are higher than XYZ by a factor of 5 to 10x. As an aside, this means you can drop all those charts showing how Japan's stock market, or whatever stock market, is cheaper than the US stock market, using an array of valuations such as price to earnings, Shiller price to earnings, price to book, etc., without also taking into account some basic return measures: return on equity, return on assets, return on invested capital. You'll find the more valued markets generate better returns on capital, and therefore should be valued higher. That you shouldn't buy stocks at their 52-week highs, but wait for dips. Okay, another thing, I used to think, right? Okay, I'm going to look at where the stock price has been over the last 52 weeks. If it's near the high, I'm just going to write off that investment opportunity, because it must be overpriced if it's near its 52-week high. I really like this way of looking at it, what Chris Meyer says next. And he did the same thing. He used to pass on stocks sitting at their 52-week high, would try to wait for dips, preferred to buy stocks at big discounts to their 52-week highs, right? As if the 52-week high has anything to do with what the company is worth. It's cost him over the years. One thing his study of 100 baggers taught him is that the best performing stocks spend most of their time near their 52-week highs. Okay, I don't know why I didn't think about this before. Maybe part of it, Li Lu used to talk about looking at value line, looking for companies that were near their 52-week lows or at their 52-week lows. That's not to say that's not an approach that can work, but it sounds like Chris Meyer is suspicious of that approach. Because of this, it makes sense that some of the best companies, they're always going to be trading around those 52-week highs and setting new 52-week highs. A stock that is a great performer over a long period of time, exactly the kind of stock you want to own, is a stock that is putting in new 52-week highs fairly regularly. A beautiful long-term chart that is up and to the right. How else could it be a great performer? It makes so much sense when you think about it in this way. Conversely, what stocks tend to spend most of their time near the lows? The ones you want to stay away from, right? And yet I used to arrogantly believe I could pick which one of these bottom dwellers would be winners. Okay, that is a very difficult game. He says I'd find a stock that sucked for years, but of course, after I buy it, it's magically going to be a winner. That's, again, a very difficult game and usually a loser's game. There are exceptions. Obviously, the other thing his study showed was how all these big winners suffered heart-stopping drawdowns. Okay, I mean, just look at Amazon since Amazon's IPO. I think it's drawn down more than 90% on at least a couple occasions. That is very tough to stomach as an investor. Because, I mean, you're looking at it, you're holding, it drops by 90%. It needs to be a 10x just to get back to even from that point. That's a very challenging, psychological position to be in. So that's I really like the way Meyer frames that whole thing about the 52-week highs and the 52-week lows. Finally, the most asked question: what stock do I think could be a 100 bagger? Right? Obviously, Chris Meyer gets asked that all the time. It's funny how he responds initially. I wouldn't want to saddle any small cap stock with such expectations. But, he's going to give us something here. And what he gives us is 6 of his 11 companies that he owns in his portfolio. So not necessarily the ones he's most bullish on in terms of thinking they could be 100 baggers from here. I'm guessing he left off a few smaller companies that he may still be adding to. But, Evolution Gaming, based in Sweden, Constellation Software, almost there for him, I believe is what he's saying. That since he bought, it's almost a 100 bagger in his portfolio. Topicus. A couple of stocks I own are already in the club. Copart, Hyco, but I believe they're still great businesses with bright futures, well worth holding. Again, this doesn't mean that he would be a buyer at today's prices in these companies or at kind of wherever they are in the market cycle, or their own growth versus maturity versus decline cycle. Anyway, I'm not going to pitch my whole portfolio to you. I own 11 names, and I've mentioned 6 in this post. So the early one was Texas Pacific Land Trust, Evolution Gaming, Constellation Software, Topicus, Copart, and Hyco. That's 6 companies. So, I might make a follow-up video to this. I might look at these 6 companies and kind of run them through, how I initially filter companies. Is there a VIC write-up recently? How many gurus own them? What is the insider ownership? Okay. What kind of debt? What is their debt situation as compared to operating income? Earnings yield, return on invested capital, all of that stuff. So let me know in the comments if you'd be curious to see me run these 6 companies through those filters. I'll probably do it anyway, but let me know if you'd like to see that. And yeah, again, highly recommend, guys, subscribe to Woodlock House Family Capital's blog. Chris Meyer puts out a blog post every week or two, and usually it is well worthwhile to read. So hopefully you guys enjoyed this. There's a lot in here, but it's gold. We got some golden nuggets in here. So again, I will link to this blog post in the description. And just wanted to share this. It seemed timely, right? Just posted 16 hours ago. So anyway, guys, thanks for watching. Happy hunting for those 100 baggers, and I will see you all in the next video. Take care.